Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with the man, myth, the legend, someone that goes by Millennial Mike. How you doing, buddy?
I'm good. I'm excited to get this started. The Q&A, the weekly Q&A we do from the comment
Yeah.
section. So if you're watching Mike's videos and you leave a comment down below with a good question or maybe a little bit of a spicy comment, we try to give them an opportunity to respond to it here long form. So we're going to start today with a question about
Quick,
wage
quick,
inflation.
quick thing. I want to give you a personal shout out. So if you follow my channel on YouTube, you know that I do this to help people. And over the last couple of months, the channel has grown and I'm, putting some dollars in my pocket that I don't need. So I am now taking those extra dollars and buying ads on channels like Reventure Consulting. And the reason I wanted to give you a shout out is because you've created the ads. We have two versions, both about 2 minutes long. I'm going to spend $2,000 this month, a lot of it on Reventure Consulting. Just trying to show people what is possible if you focus and do the work and you stop watching fear. So I am personally going to hand Reventure Consulting probably $1,000. And I want to thank you for that. So anyways, go ahead.
Yeah. And for anybody who wants to see the ads, I can leave a link to them down in the description below. They are uploaded to his channel. Like it's the main video. When you get on your channel, one rental at a time, it pops right up. So, if you like it, let us know. If not, well, maybe we'll talk about it in our Q&A session. So
there you go.
So the first topic for today is wage inflation. YouTube user Addison Schmidt asks, she says, question regarding wage inflation. Could you explain a little more on why wage inflation would stick around? I'm no expert, and in my mind, if companies are going to start cutting, wouldn't wages potentially stop climbing? Or maybe those who didn't see wage increases are just missing out. So what do you think, Mike? If wage inflation, because you've said you think it might stick around for 5 years, but if companies cut back and we go into a recession, is that still going to happen?
Yeah. First off, people need to stop watching, all the negative headlines. We have to look behind what is really going on. For example, in the latest JOLTS report, we actually have more openings last month than the month before. What we really have is an economy that's bifurcated. I actually believe that we are probably going to see more white collar layoffs than what is generally called blue collar. We are seeing the highest inflation in service-based industries. Basically, what I see going forward is there's been a lot of jobs, I guess you would call it, or careers that have been underserved. And if you're in one of those, you're going to get a lot of wage inflation. I think blue collar, I think trades. I think there's a lot of growth in income coming. If you are yet another project manager at some tech company, it's going to be, I think white collar suffers. But I think generally speaking, when you put it all together, wages go up. We still have almost 2 openings per employee. Yes, I know so-and-so mortgage industry cut 1,000 people. So-and-so did this, so-and-so did that. I get it. I do expect unemployment to go from a record low 3.7 to 5 or 6. But again, folks, for most of my adult life, 6% was considered full employment. It just was. And then the other thing that I think is happening right now across the country is unions. Unions are becoming stronger and stronger. We've seen it at Amazon, Starbucks, Apple, more and more places. I think as unions strengthen and grab hold, that will mean wages go up again. I think we have a wage inflation spiral staring us in the face. The last 3 months have shown that. It's one of the reasons I understand that headline inflation will be lower this month, but I think core could be up, which would be really frightening. So yeah, it's not as simple as, hey, Walmart laid off 1,000 people. Why isn't wages going down? That's not how it works. It's a complex job market.
Interesting. Yeah. And we have seen titles and headlines saying things like, yeah, Chase Bank laid people off, or Walmart. Some of these companies have hundreds of thousands. Walmart has 1 million+ employees. So you contextualize it.
Yeah. It's pretty crazy.
All righty. So T-Blaze asks, thanks. He says thanks to his video between you and Matt. You guys talked about possibly needing less cash for single-family homes moving forward. Can you elaborate on this? And your response was seller financing equals less down possibilities.
Yeah. So Let's kind of, I love, first off, Mike, thank you for going through all this stuff. I still am the only person that replies to my comments, and I just don't have time. And that's a wonderful thing, right? To get as many comments as I get in interactions. I wish I had more time. I don't. So I love these long format. So here's the deal. We are experiencing an epic housing crash right now. I believe ultimately it'll be just as bad as 1981-82, where things fell 50%. I know with certain, because again, I have taken the time to study the early 80s, right? You can go to your Google search bar and look up articles and real estate investing things from the 80s. It's powerful. And what transpired in the early 80s was creative financing. I mean, I have talked to more and more folks the last 6 months whose parents bought a home with a second mortgage because, again, they couldn't do this, they couldn't do that. So the seller sold and carried back some of the debt. What is going to transpire if you do the work, if you understand creative financing, is you will have dozens and dozens of opportunities to buy property with little down because you can creatively structure loan products, a first and a second small down payment. I mean, if you take the time to follow Pace Morby, he's buying apartment buildings with little down. So again, single family homes is probably the easiest thing for people to understand. That's why we talk about it. I'm not about hundreds of units. I'm about one rental at a time. So yeah, I'm marketing directly to owners with lots of equity because I would love to buy. I mean, I'd love to deploy millions of dollars in low down payment seller finance deals over the next 2 years. So that's what I'm looking for. So it's very, very possible.
Yeah, I think personally, seller financing is going to be the wave of the future. You know, at some point, people went away from buying all their cars from dealerships and used car lots because the internet got invented, or even personal ads, and you're able to go person to person to buy stuff. I think the same thing is going to happen with houses. It's going to become cut out the middleman, get a good contract, let them give you a reasonable interest rate. I think people who understand seller financing are going to be the best equipped moving forward to be successful at just buying a house or being a real estate investor.
Agree 100%.
Okay, so back on the topic of inflation, Angel Arguin, hopefully I said that right. He asks, have we hit or are we close to hitting the bottom of inflation? And you responded with the bottom of inflation. Nope, that's years away.
Yeah, when I saw that question, I'm assuming he meant peak inflation because the bottom of inflation is years away. We may not see the Fed's goal of 2% inflation, which I would call the bottom. Man, it might not come till 2024. I mean, think about that, right? That's years away. I'm going to assume he meant peak inflation. And there's really two answers there. Headline inflation, maybe. Although if you heard my daily financial news this morning, you could see that I'm nervous about food as we enter the winter. We could be shocked, right? Oil, I mean, supposedly Russia's turned off oil and gas to Europe, indefinitely. That's a problem. We now have OPEC cutting oil. That's a problem. We will eventually have to replenish our strategic reserves. That's a problem, right? We're basically going into winter where we may have a lot of artificial demand and less supply. So, and then we have, record low yields on crops. I mean, I don't have a great feeling about Q4 for all kinds of reasons. But let's just assume that peak inflation has come in for headline. I am actually most concerned about core inflation, which even though headline inflation is now down from, I think, 9.1 to 8.5 or 8.3, core hasn't moved. Core is a problem. Wage inflation, as we talked about in question 1 or 2. Rent, owner's equivalent rent hasn't reared its ugly head yet, and someday it will. So I am not convinced that core inflation is peaked. You could twist my arm and get me to say that 9.1 will be the highest print for headline. I could get there, but I'm not willing to say that core inflation is peaked yet, which is really a big problem.
Right. And just so everybody knows, the theme for all of the videos today is going to be inflation. We're going to be doing a Dave Ramsey's reaction video for inflation, and Milton Friedman, for those of you who know the most famous economist of all time.
And I've studied Milton Friedman. He was ahead of his time.
Yeah, and we have some good videos from them that you're going to react to next. Okay. Okay. So on the video you did with the lumberjack landlord, you and him disagree on median prices dropping. And Farda Plata asks, fascinating conversation. What impact do you foresee the student loan forgiveness having on the bottom sliver of the housing market? Do you see starter homes appreciating while the high-end market not so much? I assume that the question is, if they forgive student loans, more people will be able to afford starter houses. Will that affect the prices?
Yeah. So again, if people watch my channel and why I always talk transactions first, I'm a supply demand guy, right? That's my background, right? Studied economics, you know, as a degree, right? So, I think they're onto something, but there's a step A, and I think they jump to step B. I think it is fair to say that at the margin, somebody who has their student debt forgiven will be closer to getting a yes answer from a bank, which is where this all starts. So yes, I think it's reasonable to assume, and I've heard the number as high as 20 million people will have their debt forgiven entirely. That will, without question, likely increase credit scores and make debt to incomes look better, which means the chances of getting yes answer for a bank go up. That's just simple reasons. And then, yes, I would fair to assume that these folks would most likely be first-time home buyers, which would mean demand goes up. And if you follow my channel, you know I think we have a generational low in supply. You have higher demand into weak supply. It's reasonable to assume that I think prices are firm. I'm not a housing bull. I just happen to not be a housing bear. I think the median home price is basically flat, give or take 2 points for 5 years. So no, I don't think they go up. I just think it's more demand at the margin.
Okay. All right. So let's talk about rising interest rates. Oh, no, hold on. We have a good question here from somebody who actually is a fan of yours. He said that he left you a 5-star review when you were trying to get over 1,000. So we'll thank Charlie Ferrulo for that. But he does want to hold you accountable. He says, you could still be right, and a housing price crash might not happen here in America. You've been swearing up and down that it would only be a transactions crash. We need some accountability, and it definitely seems like it's about to start. So we need a video or something giving the parameters of when you would consider yourself wrong about a price crash.
So I think I replied to that. Can you read my reply?
I didn't copy it, but I have it. Remember, you said a 20% drop in prices is a crash and a 10% drop is a correction. Those were your words.
Yeah. So, and I think also I said there, if either of those happens, I will own it.
Right.
Right. Again, just to be clear, right? I call it, and let's be very clear. I think this is what I said. A crash of 20% in a calendar year is a crash. A drop of 10% in a calendar year is a correction. I will own both of those. I still do not believe we will see either one. People, I mean, I had another comment yesterday, I think, basically saying, hey, I suggest you get softer on your no crash call. It will make it easier for you when you have to tell everybody you're wrong. I'm like, you freaking don't know me from Adam. I don't give a shit if I'm wrong, but I'm going to stand by what I believe because I'm not going to say anything just to get some stupid algorithm to show my video more. I'm sorry that I don't believe a housing crash is coming. I would have a bigger channel and a lot more revenue if I would just say housing crash, housing crash, housing crash, and then I would delete the videos when I'm wrong. I don't do that. If I'm wrong, I'm wrong. Frankly, as I've said a million times, I hope I'm wrong. I have a lot of money that I could deploy to buy 70% crash like last time. Folks, I've been doing this so long, I experienced and profited from the last crash. I got out of the market at the peak and in at the bottom. I'm not some rookie talking from my mom's basement. I've been here before and I'm ready for it. I don't see it, so I won't say it. Stop. I'm not. I don't see it. If I ever do, I'll tell you, but I don't see it.
So the answer is a 20% drop in prices
in
over
1 year,
one calendar year is a crash.
crash.
So then the next logical question is, okay, but what if we saw a 20% drop in prices and it was over 2 years? What would you call that?
That would be a correction.
Okay, so that's still a correction. All right, and then if we see a 19% drop in prices over 1
if
year,
we are over double digits, nationally speaking, I will own the mistake.
Okay. All right. Well, there are your parameters, Mr. Charlie Ferrulo. Hopefully we specified it in enough detail. Okay, so rising rates. Nicholas Massey says, if it gets to 7%, Mike, should we now stop focusing on finding a deal and focus on paying down the houses we already have until the rates drop again? Looking for your wisdom. You responded with, focus on finding motivated sellers and only great deals at 7% cost of capital.
And that's, again, I'll take this question another way. Let's just assume the cost of capital was 10%. If you are in growth mode, you are in growth mode. You should be looking for deals that cash flow day one, that cash flow with 30-year debt at 10%, because you don't do adjustable rate mortgages if you follow what I say. And you just buy stuff that cash flows. And the only way you're going to do that is from motivated sellers. Folks, if you follow one rental at a time, you are doing the work 20 minutes a day, every day. You are fishing for motivated sellers. And I promise you, rates get to 7, 8, 9, 10 in the winter, which is right in front of us. More and more listings will be motivated sellers. Who the hell wants to list a home, a duplex, a quad for sale between Thanksgiving and Christmas when rates are 8%? No. So write low offers, write stuff that makes your yield great. If average is 6, write 9s. If average is 9, write 12s. Just get off your ass and do the work. This is the time to do the work. You make legendary wealth in bad times. I made most of my wealth, or more than half of my wealth, in a bear market, in a crash. If I borrowed at 12%, if I would have focused on paying off my 8 mortgages at the time, instead of borrowing at 12%, I would still be working because I was in growth mode. It's not about debt. It's about finding great deals at the current cost of capital. Stop overthinking.
Yeah, you just have to find a way. And this kind of goes back to our seller financing option earlier. If it's very hard for you to make a deal pencil out, which will happen, which is going to happen with most of the deals on the market. One option is putting in low offers and finding that motivated seller. And the other one is going direct to sellers who have equity that you can strike a fair deal with that's profitable to them and makes it work for you. So there are options around it. But like Mike says, if you're growing, right now I've got 8 rental properties. I'm not going to slow down. I just have to get more creative. So I have no plans of taking a 5-year hiatus and paying stuff down. This is nothing to help me.
Nope, nothing.
Okay, Jeff M, the legendary Jeff M. What if rates fall? He says, we obviously all want to see massive price drops so we can purchase real estate. Do you think if we saw 3% mortgages again, that real estate would continue to just skyrocket like it did? Or do you think we would see people to be eager to sell all these homes that they purchased during the pandemic so they can purchase move-up homes? So what do you think happens if it goes back to 3%, Mike?
You know, when I get a question like that, I really am. I get kind of, my brain works really fast. I get a fast answer, and then I get like a deeper answer. So my first gut reaction is, oh my God, if rates got to 3% again, it's a bananas market, right? So it's just prices go bananas. So that's kind of my knee-jerk reaction. But as I think about the question in more detail, I think he's right, kind of in his subtleties. But kind of right and wrong. So A, it will undoubtedly unlock supply. Because right now we have supply locked up because, I mean, I just spoke with Anna Kelly 20 minutes ago. She has a friend who is single, right? A baby boomer whose husband passed. She is in a massive home. She is looking to trade down. Right now, she can't buy a home that is 40% of the size of her current home for a mortgage payment that is less. So she is staying put.
Jeez.
This is happening so we have record supply. However, to Jeff's really insightful question, if rates crash to 3%, that unlocks a bunch of supply. However, it won't be as much supply as Jeff wants to bring prices down. It won't happen. Prices will go bananas. We will go from doing 4 million transactions to 8 million transactions, but prices will be stupid. Because again, what happens is the move-up buyer, to Jeff's point, unlocks. And a move-up buyer is 2 transactions. It's a sell and a purchase. What have we lost, and why will we have sub 4 million? The move-up buyer is dead. So we're only getting first-time buyers and second home buyers and investors. We've lost an entire segment of the market. So I have good news. Jeff kind of showed something that I missed. It will unlock supply. Awesome. But unfortunately, it won't be supply that dwarfs demand and prices will just go stupid. I mean, God, prices will go crazy. At 3%, oh, go bananas.
Yeah. I know I'll be refinancing a few mortgages.
Exactly. And then we do it again. And I mean, just.
Yeah. I actually do want to look right back at that first sentence because I've noticed a theme with Jeff M. Jeff is looking to buy his first home. I've read so many of his comments at this point. He's looking to buy his first home. He's desperately hoping that there's some situation or some scenario out there that's going to cause the market to come down to what he deems affordable, 20%, 30% drop in prices so he can get in. And the first sentence of that question was, we obviously all want to see massive price drops so we can purchase real estate. But that's the problem, Jeff. If everybody wants the price drops and there's all this capital sitting on the sidelines, if prices even quiver in the downward trend, people are jumping in and demand's coming roaring back. So I just don't see a scenario where you get your drop.
It's not coming. I've told them 1,000 times, but you can keep wanting it. It's fine. But again, let's also remember what happened. Cost of capital has gone up. Cool. It's gone up so much, guys, that Blackstone has stopped buying in my market. It was Fresno, Memphis, and Boise, right? I invest in Fresno. They stopped buying because cost of capital is up. It's unaffordable. I promise you, rates get back to 3%, Blackstone's coming right back in and dominating my market. It's just all this capital is looking for return, and single-family homes is a proven place to get it. It's not coming. Sorry. At least as a country, if you're in Vegas or Phoenix, you have some pain ahead, no doubt, because of Open Door.
Okay, we got two more questions. These ones are a little bit longer. One of them is on Grant Cardone's advice. YouTube user Hacker asks, I'm one of the folks considering turning my property into a rental. I've asked your thoughts on the Grant Cardone strategy of rent where you live, but rent out what you own. You mentioned that you're opposed to that strategy. He says, I'm not married. I live alone. I've done the math. If I pulled the trigger on it, it will increase my disposable income. Not as much as I would by house hacking or renting rooms out, but I'm not going to do that. I'm too old. If I do it, would I qualify for one of your cards, even though you don't agree with the strategy? So if he does end up doing this strategy, will he still get one of your cards?
Of course.
Yes.
Of course. I'm such an easy grader. If you want a card, give me your address. I'll mail you a card.
4 of them right here, fellas.
There you go. Yeah, again, I'm an easy grader. If I help you in any way, of course I want to recognize you, give you a shout out. I mean, gosh, hopefully everybody knew what my answer would be for that. But let's go back to the bigger question at hand, right? He gave variables, and I think I replied to this one as well. I would tell him, again, given the variables that he gave us, absolutely, go for it. And I think what I said, if I didn't, it's just because I couldn't type the reply. It wasn't an option for me. I would have never done it. I was raising a family. I was married with kids. My number one goal when buying our house was for us to be in that school district for 15 years. Not an option. Not an option. I didn't want to put my family at risk from a landlord selling a house or this or that. So we bought. It wasn't an option for me. But yeah, given what you said, Hacker, and I think I replied to it, not only do you get a card, but yeah, go ahead. If you've done, folks, if you do the work and you do the math and you come out positive, why does my opinion matter? If you think it works for you, go nuts. My opinion doesn't matter. You're a single person. I actually don't know if it's a man or woman. Single person. I was a married man with a young kid who we wanted Teresa to be in this school district from kindergarten to graduation, high school graduation. So I had different priorities. Your priorities are different. Go ahead. Follow Grant Cardone's rent where you live and own others. Awesome. Go nuts. Get a card.
All right, cool. All right, the last question is for Mr. Zuber, the economist. They want you to put on your economics hat. Mr. Balloon Pimp, that's his name, says, I have a question and a video suggestion. As an economist, Mike, why does the government not just look at or lock in a fixed rate for the national debt and revolving debt? I heard the government is currently spending 5 to 7 trillion a year. As I understand it, they finance that debt. They then pay with taxes that come in approximately 4 trillion a year. The overflow, they can't do anything about that other than spend less or make more money. But why would the debt that the government has not get a locked in rate? What is the reason?
So the government debt is locked in. It's just it's called variable duration, right? 10-year treasuries, 10-year fixed debt, 30-year treasuries, 30-year fixed debt. There's been a lot of discussion. Actually, one of the most common discussions early in the pandemic was the Fed should remove the variability. There was actually talk of doing 100-year debt because rates went so low. I don't think they did that. They should have, but they didn't. Yeah. So again, the Fed debt is locked in. It's just called variable period or variable duration. They should be. They should take when rates are low. They should buy longer term, and then when rates are high, they should do shorter duration. There's some of that, but not nearly enough. Again, they're part of the bond market and liquidity, right? They are the largest buyer most of the time, sometimes the largest seller with QT going on. So I don't know where Mr. Bloompip is reading or all of that, but yeah, the government debt is fixed. It's just variable duration.
Well, Mike, those are all the questions I have for you today. We're going to be moving to a couple of videos that people sent us. Again, Dave
Nice.
Ramsey's pissed at the Fed, pissed about inflation, and Milton Friedman is going to give us his 50-year-old take on inflation. It's probably still applicable today.
I think it is. Well, Mike, again, thank you so much. Going through the comments, finding amazing questions, spicy questions. It's great. It allows me to go deeper. Man, thank you so much.
No problem. Happy to do it.
All right.